Hey guys, Whitney here. Welcome. Tuesday after Memorial Day. I hope everybody had a fantastic weekend. I know we enjoyed playing in the fun and sun here in Boulder, Colorado. I'm going to give it just a couple minutes for everybody to kind of file in the room. If this is your first time attending the Passive Investing Made Simple show, make sure that you find your Q&A box. That's where I'd love for you to drop in all your questions that you have. Don't hold any questions. Whenever you have a question, drop it in. That way, if it makes sense for me to answer it in line with the presentation, I can get that done. Otherwise, we'll just hang out for a few minutes after and get everybody's questions answered. Also, for those of you who are joining live, and if you don't know this already, I'm going to go through the content of today's presentation, and then we'll have a little Ask Me Anything session at the end. So don't go anywhere. Okay, I am your special guest today. So welcome. But let me go ahead and kick this off. Welcome to the Passive Investing Made Simple show. This is a weekly live show where I help you go through all the ins and outs of passive investing. Answer the questions that you may be thinking about of if this type of investment is right for you, but more importantly, help you go into your first or next investment with confidence. And today, we have no additional guests. I am your guest, and I wanted to go over a very powerful investing strategy that I learned from my CPA called the Lazy Man 1031. Now, as you can imagine, I'm not a man, and so many investors out there aren't. So I just redubbed it the Lazy 1031. However, this isn't a unique investing strategy. I know a lot of people have, reached out to me over the past couple of weeks, and since we mentioned that we were going to do this webinar, and said, "Hey, listen, I learned that from my CPA. Isn't that pretty cool? Somebody out there should really trademark that." So I am so excited to go through this type of investing strategy with you. Now, in the show, like I said, we help you learn how to utilize passive investing in order to not only generate cash flow now, but also build long-term generational wealth. We also help you learn the biggest myths that investors have about passive investing that keep them sidelined and never getting started. Also, I'll help you learn some different terms, some pros and cons, and even sometimes we tackle math around passive investing so you can avoid making costly mistakes. And more importantly, like in today's episode, I help you put this knowledge into action so you can go confidently into that first or next investment. Now, one of the biggest myths that I run into in my conversations with investors is they tell themselves that investing passively they can't make that high of a return. Maybe it's cash flow, maybe it's equity, or maybe in the case of being able to defer taxes, they just don't feel like they can make that high of a return. And I'm going to show you that that's actually not true. Passive investing can actually help you in many different cases save on taxes. So before I get started, this is me, my crazy Q. This is the whole reason why I invest in real estate, especially passively. I started off as a live-in flipper and house hacker. Okay, those terms, we know them today. Back when I started in 2002, they weren't generated at that point in time. But I started off, in real estate completely by accident. I bought a property with a significant other, and then a couple of months after we closed, the relationship fell apart, and here I had a house. And so I learned very quickly, checked a book out from Home Depot, the Home Depot 1-2-3 book, and learned how to do all sorts of repairs on that house. Quite honestly, out of self-preservation. I did not have any intentions of investing in real estate. Now, amplify that a few years later, my husband and I decided to actually start holding on to some of the flips we were doing to build a portfolio of passive income. And then it dawned on us one day that we really wanted to be able to scale our portfolio further and remove ourselves from that part of the business. That way we could spend more time with family and friends and travel the world. And we had some pressures on ourselves. You guys have probably heard me talk about this on several podcasts. And we had a little daughter at home. I was taking care of family. And it was just out of necessity that we had to figure out how to scale through passive real estate, as well as, continue to build the active side of our portfolio so we could continue to build equity. Now, that landed us in a bit of a pickle here about 3 years ago, because we really wanted to start moving a lot of our portfolio to the passive side of real estate. But here we were actively owning assets. And that's why I'm so excited to go over the lazy 1031 with you guys today. Something that my CPA encouraged me to look at in order to take advantage of growing asset prices, but also not be pressured into some of these other different tax strategies to defer capital gains. Now, guys, just over the past few years, we've been able to build a portfolio of 6,300 multifamily units, and actually those are all residential units, 1,400 self-storage units. But those are all metrics. Really what passive investing gets you or can afford you is the result. And that is that we have 100% control on how we spend our time, which is so amazing. We both still work very, very hard, love driving value in the world, but we get a choice on, how we do it, which is, again, what most people like you, our investors, are here to learn how to do. And we can help you do that at passiveinvesting.com. To date, this number has been going up very rapidly this year. We have a portfolio value of over $1 billion of real estate, multifamily, self-storage, car washes, and soon to be hotels. We've acquired over 4,300 multifamily doors. And then what I get to do here on a daily basis is work with you guys, our investors. Now, this is a little bit different than our guest episodes that we've done. So we're going to be going over a lot of specific education today, and maybe even diving into a little bit of tax strategy. So, in these type of sessions, I just have to throw out there, this is not financial advice, tax advice, legal advice. So make sure you take anything that I say and consult your professionals before investing. All right, now let's talk about the lazy 1031 exchange. That's what you guys are all here for. Like, what is this? And exactly how lazy do I get to be? At least that was my question. Now, we have to actually kind of backtrack a little bit, because maybe you don't know what a 1031 exchange is, let alone, if we don't know what the 1031 exchange is, we don't know what a lazy 1031 is. So the 1031 exchange actually started in 1921 after the first tax code was enacted. And actually in that iteration of the 1031 exchange, it allowed for the exchange of any property or business. So it didn't even have to be a like kind asset. It was just, you just could do defer taxes flowing back and forth between business and real estate. Now, as you can imagine, there was a lot of people that took a lot of advantage of that, but that was actually removed from the tax code in 1924. And so what we have, the 1031 exchange has kind of morphed a little bit, but the basics of it, the nuts and bolts of it, has actually been on the books since 1924. And that is that this particular part of the tax code, which is number, provision 1031, allows for the like kind real estate asset exchange in order to defer capital gains and depreciation recapture. Now, why would the IRS do this? Okay, and why would we even consider going into a 1031 exchange? And that is because the tax code actually shows us where we as investors should be putting our money, one, to get tax breaks, but two, to help the government solve problems. Okay, they're not very good at starting businesses, and they're not very good at solving real estate issues. And so that's why if you follow like Tom Wheelwright or Robert Kiyosaki, and really any sort of tax strategist, Amanda Hahn, they all tell you, look at the tax code, because it's like a treasure map to tell you where you should be putting your money as an investor to get the best breaks. Okay, now the 1031, this has been on the books since 1924. Okay, so the government wants us as the private individuals as much as possible to solve these housing issues. And so they give us this 1031 provision, one, so if we sell an asset, we can trade up for a like kind asset. Okay, we can go single family to multifamily, single family into self-storage. But one, to continue solving problems, two, to keep our capital working hard, okay, with no downtime. That's the beauty of this type of strategy. But it does come with some hangups. Okay, but before we get into the hangups, this is a kind of a general outline of what a 1031 exchange looks like. Essentially, you're going to sell the asset. Now, this is what we do here at passiveinvesting.com. When we sell an asset for a multifamily asset or a self-storage asset, we're gonna sell the asset, okay, at least get it under contract. We're going to go to our investors, okay, we're going to say, hey, would you like to stay in the 1031 exchange or not? Okay, if you're doing this individually, you're going to make a decision to sell your asset, and then you're going to decide, what am I going to do with that gain, and how am I going to handle the recapture of any depreciation? Okay, if you decide to go into the 1031 exchange, now a replacement asset has to be identified. Okay, and if you're staying with us in the 1031 exchange, we pull other investors to continue to go buy the new asset. Now, okay, I distilled that slide down into like 4 main buckets, but we've got a lot of moving parts to pull off a 1031 exchange. We have to sell an asset, identify a new asset, okay? We have to do all of this within 45 days, then we have to be able to close in 180 days. We have to get a qualified intermediary involved to handle the money. We can't touch it, okay? There's a lot of moving parts in here. Now, there are some other things that might keep us from doing a 1031 exchange, okay? Because usually the best time to do a 1031 exchange is to lock in high asset prices, very much like today. However, it's the same time, the best time to do a 1031 exchange, it's also probably the worst time to do it, because you're also going to be buying at high asset prices. It's going to be very hard to lock in low value, that typical buy or sell high, buy low type of cycle in order to build equity. Again, there's a huge calendar that we have to follow. There's a lot of deadlines. So you have to find a replacement asset in a certain time period. You have what I call a spend up provision. Okay, think of monopoly, right? You're going to have your single family properties, right? But then you have to like roll them up to go buy a larger property. Okay, you don't actually have to consolidate to buy a larger property, but you have to spend almost the exact same dollar amount. Okay, so you can't consolidate all your cash across your properties to own something free and clear. Okay, so we have, I guess I kind of like term it like a spend up provision. Okay, it makes it a little bit more difficult. There's some math there. We can't move asset classes. And what I mean, we can't go between business and real estate and business. Okay, remember that got removed in 1924. That provision's gone. Okay, and we can't move from active to passive, meaning if you're like me, and like the problem I had a few years ago is I had all these single family properties and I wanted to start moving my portfolio to passive real estate. I couldn't do that utilizing a 1031 exchange. Okay, so now I have to put a little asterisk there, because there are ways to go into syndication, potentially with an operator, but you're going to have $1 million or more potentially in order to do that. Okay, so if you've got $1 million in equity lying around, or maybe even $500,000, reach out to me directly, because I can demonstrate or talk to you about doing what we call a tenant in common on some of our properties. But for most people like me, if you're selling a single family property, maybe you harvest, $30, $60, $70, $80, $100,000 per property, you're not going to be able to go into a passive syndication through a 1031 exchange. Okay. Now there's some other alternatives out there, and I'm not going to dive deep here. Okay. But we'll tackle some of these topics at different time, but there are other opportunities out there to defer capital gains. There's opportunity zones that you can invest in. The laws are still being solidified around opportunity zones, and they're very untested. Okay, so for me, like I personally am not looking to invest in opportunity zones for that very reason. You can go into what we call a deferred sales trust. Now, we've had Brett Swartz on here from Capital Gains Tax Solution to talk to us about that. You can put together your own private DST. Now, that is great if you have $1 million plus in equity to move into that type of exchange. It also comes with ongoing annual fees. All right, so this is not the type of strategy that's available for everybody, and it's not for the weak of heart. Then you have what I call like bank DSTs. Okay, some capital bankers will have opportunities to go into an investment that looks very much like a syndication, but they're actually a DST that you can invest in. Oftentimes these guys have very low cash flow, and they're actually not the right type of deal that you might want in your portfolio. Okay, but they are available to you if all you need to do is defer the capital gains. Now, why do a lazy 1031 exchange? Okay, before we actually go into the steps on how to execute one and what it looks like, let's talk about why to do it. And as you can see here by the picture, I love this type of exchange, quote unquote exchange, is because it gives me options, lots of options, lots of flexibility. Okay, the advantages: I can avoid the pressure of having to buy a high asset price or an asset at a very high price. It allows me to move from active to passive. I can move my equity on my single family properties or small multifamily into passive real estate. Okay, I can make that transition. And it allows you to diversify your portfolio. So I can go into, multifamily, self-storage, car washes, hotels, you name a strategy, I can layer it in there. Okay, it allows me to consume part of my gain, meaning maybe I'm walking away with $300,000 in equity. I can do a lazy 1031 exchange on 250,000 of it, and maybe take the other 50 and go on a really nice vacation, or invest into get into buy a car or something like that. I can actually, or do some improvements around my house. I can actually do something with that cash. Okay, I can actually invest with an operator who does a 1031 exchange. Okay, that is one of the advantages. I can actually now get out of my own controlled real estate and seek out those operating teams that will do a 1031 exchange on my behalf. Now, a lot of operators say they will do that, but they're not necessarily good at executing. Okay, so also, and the next bullet actually is its own bullet. I can actually start investing in building up a bucket of losses, meaning as I continue to invest in passive real estate, I can really amplify my bucket of losses that are being built up and use them year over year. So now I can walk that line in between active real estate, buying my own single family portfolio, or maybe doing a short-term rental. And then I can use those, the losses from my single or syndicated real estate to offset over here. I can really kind of start moving back and forth, moving those monies, those tax savings back and forth. All right. Now, again, talk to your CPA about all this, because there are certain provisions that would keep you from using those losses to offset each other. All right. Now, there is a big disadvantage here. Okay. If we do a lazy 1031 exchange, we may not be able to actually offset all of our gains, meaning that we probably will have some tax bill due to us. And that is just something that I think, at the end of the day, you have to evaluate what's more important to you. Continuing to manage your assets, you being the asset manager of your assets, or deferring that out to a expert operational group. Okay. I guess it kind of boils down to like, how do you value your time? Now, there are certain assets out there that have a high, right now have a high amount of bonus depreciation attached to them. We can also accelerate a lot of the depreciation. And so we can actually, potentially provide losses at a pretty high rate for investors right now. So how do we actually execute this 1031 or lazy 1031 exchange? Okay, step one, there's 2 steps to the process. Pretty simple, guys. First, you need to sell an asset. Okay, and maybe it's single family rental, you're a small, or maybe your personal residence. Okay, whatever it is, you need to be sell an asset. Okay, you will be on the hook for paying the capital gains on that and the depreciation recapture. Okay, it's called consuming. But try to do it as early as the year as possible. Guys, right now we're at the end of the 5th month. Okay, we're recording this in May 2022. There's still plenty of time to execute this type of lazy 1031 exchange. Okay, and then 2, reinvest all the capital, including your down payment, okay, your down payment and the gains, into a new asset in the same calendar year. That's the trick. Okay, so you sell, take everything over, move it into a new asset. Okay, and you're looking for assets that have a favorable accelerated depreciation and bonus depreciation schedule on them. So you're looking to invest with operators that are going to do what we call a cost segregation analysis on their properties. Okay, that way, no matter if the asset closes on December 31st, 2022, you're going to get depreciation for the full calendar year. Okay, so it's really important that those money is being reinvested in the same calendar year. Okay. Now this kind of goes back to which type of asset is maybe more favorable for this type of lazy 1031 exchange. If you're somebody who needs super high tax benefits right now, we have 100% bonus depreciation for this year, unless Congress does something. This is the last year for 100% bonus depreciation. Multifamily can be really attractive. So can self-storage for generating high losses. Now, multifamily, maybe a little bit more so because the depreciation schedule is on 27.5 years. Okay, and we actually have things that wear out, like carpet, paint, fixtures, stuff like that. As opposed to self-storage, where the depreciation schedule is 39 years, and you're, mostly buying a garage, like concrete floor and like metal walls. Now, either one are very attractive for generating losses for people in order to offset the gain of a particular asset. Now, kind of putting a nice little bow on this for people, what happened with me when I sold those assets or started selling those assets a couple years ago is that I was able to build up a bucket of gains from my active assets that I was selling. Okay, and then I continued to immediately reinvest back into multifamily and self-storage real estate. And I was able to offset about 85, almost 90% of my tax bill. Okay, now I didn't consider that a loss because now I was no longer managing those assets myself or managing the property manager. I have now converted that all over those monies being placed with an expert operational team who has the full intent and has a track record of doing 1031 exchanges at the end of their asset. So I've just really taken it from one side of the real estate investing paradigm over to the other side and gotten my time back. And so guys, I'm happy to hop on the phone with you. If you guys are interested in this type of strategy, want to talk about it more just on a personal level or how we can help you here at passiveinvesting.com, jump on over to passiveinvestingwithwhitney.com. There you can get some free goodies, a checklist on how to invest in passive real estate, as well as, you can see my calendar and we can hop on the phone and determine if this investment's the right investment for you, as well as see our open deals. Now, here's my contact information again. Guys, I know you guys probably have questions over this. Jump on over in the chat box, and I look forward to talking to you guys very soon. What questions do you guys have?